Hello, my name is Troy Adkins, and I am the founder and owner of Adkins Capital Management. I want to talk to you today about the key housing events that have transpired in the U.S. during the third quarter of 2018. During the third quarter of this year, the micro-level housing trends reported by the New York Federal Reserve Bank, Bank of America Merrill Lynch, and Trulia, as well as the National Mortgage Settlement, the actions undertaken by the U.S. Department of Justice against Wells Fargo and RBS, and the actions of the Federal Reserve as part of its Federal Open Market Committee operations were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Adkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. With this overview in mind, let me now turn your attention to the primary micro-level events that have transpired in the residential housing environment for the third quarter of 2018. According to the New York Federal Reserve Bank, mortgage debt has reached the $9 trillion threshold for the first time since the second quarter of 2009. According to U.S. economists at Bank of America Merrill Lynch, existing home sales have peaked and will no longer contribute to the U.S. economy's growth. Sales of existing U.S. homes make up 90% of all transactions and recovered faster than the market for new homes after the housing crisis a decade ago. The peak in existing home sales can largely be explained by the decline in affordability. In terms of new home sales, there is still room for single-family construction to expand, but it is likely to remain slow given challenges finding labor and dislocations in the market. According to a report by Trulia, since the financial crisis, the housing recovery reflects a deep, fractured country. The largest distinction is the disparity between growth in urban and rural regions of the U.S. Home values in the 100 largest metro areas grew 53.1% from mid-2012 to mid-2017. That's nearly double the home value appreciation in rural areas during that same period of time. It is important to note that the National Mortgage Settlement is now complete. The massive mortgage servicing settlement, which began in 2012, was an agreement between the federal government, 49 states, and 5 of the nation's biggest banks and mortgage servicers. The settlement required Bank of America, Citigroup, JP Morgan Chase, Wells Fargo, and RasCap to provide $20 billion in consumer relief and $5 billion in other payments. The settlement stemmed from allegations that those companies were robo-signing mortgage documents, including allegedly signing swaths of foreclosure documents without properly reviewing them, evicting homeowners who are still in the modification process, and other abuses. The actions undertaken by the U.S. Department of Justice were also worthy of discussion. Wells Fargo will pay more than $2 billion for allegedly lying about the quality of subprime and Alt-A mortgages that backed residential mortgage-backed securities in the run-up to the housing crisis. According to the DOJ, Wells Fargo allegedly knew that loans packaged into the mortgage bonds in question were based on misstated income information, but nevertheless were allowed to be securitized and sold. RBS reached a $4.9 billion settlement that covers civil claims that it misled investors in the underwriting and issuing of residential mortgage-backed securities from 2005 through 2008. According to the DOJ, this is the largest single penalty charged against a single entity for misconduct, contributing to the financial crisis. Moving away from these policy issues and events, and to an assessment of the mortgage lending environment, it is important to note that for the third quarter of 2018, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 4.66% and ended the quarter at 4.71%. For only the second time since June of 2011, the national average mortgage loan interest rate for a 30-year fixed-rate loan exceeded 4.61%. In order to better assess the current mortgage loan interest rate environment, prospective homebuyers should remember that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 3.31% in November of 2012, and it reached an all-time high of 18.63% in October of 1981. In view of realized and expected labor market conditions and inflation, the Federal Reserve elected to raise the range for the target federal funds rate by 25 basis points from a range of 1.75% and 2% to a range of 2% and 2.25% during their Q3 2018 Federal Open Market Committee Operations meeting. This was the third time this year that the Federal Reserve raised the key target range interest rate. Prospective homebuyers should closely follow the level of mortgage loan interest rates in their community, because a rising cost of debt will increase the amount of interest expense that prospective homebuyers will need to pay for their mortgage loan. This, in turn, will place downward pressure on the price level of residential housing in their community. Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the impact of a changing interest rate environment. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Adkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Adkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Adkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Adkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Adkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Adkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Adkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Adkins Residential Home Valuation Analyzer. Now that I have provided an overview of how the Adkins Residential Home Valuation Analyzer is utilized, let me provide an overview of the home price level for a select group of cities across the U.S. For the third quarter of 2018, 31 cities that make up the Adkins 60 City Home Price Index were classified as overpriced for the quarter. Newark, Los Angeles, San Francisco, Honolulu, and Miami were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 4.71% to 0%. In order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective home buyers to spend more than the respective justified percentage of household income amount. In order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $66,971 and $238,588. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $139,918 and $466,997. Prospective home buyers can use the Adkins Residential Home Valuation Analyzer in order to assess the price level of homes in their community. On the other side of the spectrum, 29 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the third quarter of this year. Oklahoma City was classified as the most underpriced city in the index, while Wichita, Charlotte, and Anchorage were classified as the second, third, and fourth most underpriced city in the index based upon their justified percentage of household income amount. Wichita was classified as the second most underpriced city based upon its higher justified mortgage loan interest rate. While Little Rock, Kansas City, Pittsburgh, and Omaha had the same justified percentage of household income amount, Little Rock was classified as the 5th most underpriced city based upon its higher justified mortgage loan interest rate. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 4.71% to more than the justified mortgage loan interest rate amount for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the justified percentage of household income amount in order to repay the cost of a mortgage loan. Prospective homebuyers can use the Adkins Residential Home Valuation Analyzer in order to assess the price level of homes in their community. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Adkins Residential Home Valuation Analyzer, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. This is Troy Adkins, saying thank you for taking the time to listen to this presentation.